Welcome, everybody, to another episode of the Business Builders Podcast with Helena and myself, John. We have a very special guest today, Miss Vina Jetti. Vina is the queen of multifamily. Vina, welcome to the podcast.
Hi, thank you for having me. I'm really excited to chat with you guys today.
Yeah, so are we. So can you just give a brief introduction to, the people that don't know who you are? Who is Vina Jetti and why are you here?
Yeah, so like you said, I am Vina Jetti. I'm a large multifamily owner operator. I've bought and sold over $1 billion of assets in my own portfolio. I come from the corporate world. I left Tishman Speyer back in 2012 to start investing for myself, and I just never looked back after that. And so now we buy in Texas, Florida, Georgia, North Carolina, South Carolina, and Arizona. And we have a focus on value add and core plus deals. We've kind of shifted a little bit more to core plus now in those really strong markets. And I'm excited to be here today so we can chat about all things real estate.
That's really exciting. So for people who don't know what Core Plus is, just really quick, what is the Core Plus?
Yeah, so when you think of value add, right, that's something you go in and you actually like renovate to bring up to market. Core plus is kind of the in between a value add and a core asset, which is already everything is like newer and already renovated and up to market. Core plus is like a little bit less nice than that, but definitely nicer than value add.
Mm-hmm. Okay, got it. So you came from a corporate world and then got into investment and never looked back. That's kind of like the path that me and John took as well. I came from investment banking and John was a CPA before. So what made you make that decision and jump into investment, and how was that journey so far?
Yeah, so I started in single family. I come from a real estate background. My mom is actually a single family investor. I'm the first in my family to invest in multifamily, but I didn't know that you could invest in multifamily. I thought multifamily was for like billionaires. I didn't think it was for everyday people like me. And so I actually started buying single family homes. And my busiest week, I bought 5 houses. I put 5 houses under contract in the same week and quickly realized that I couldn't get to scale if I buy even 5, even 10 houses a week. It would be impossible for me to own 10,000, 20,000 doors at any reasonable amount of time. And so I started looking for a way to solve that scalability issue. But I really loved being in the residential space because it is a need regardless of where the market is, right? Like even with the market kind of in this weird position, right? We're starting to see the Fed cutting interest rates. Even without all of that, I still wanted to be in residential real estate because you still need a home. It doesn't matter how high the interest rate is, it doesn't matter any of that. And so we definitely like the resilience or the recession resistance of residential real estate, and multifamily really solved both those sides of the coin. It gave me scale and kept me in the residential space. And so I started buying multifamily real estate and just never really looked back after that.
So you started with the normal trajectory of starting single family and then did you jump like from single family to like 80 units, or because I know you're like 200 plus now or something, right? Like, did you
Yeah,
make that jump or you slowly started?
I did. I did. So I actually jumped from single family to 200 was my
Oh,
first
wow.
deal.
Wow.
And I was partnered with somebody. So like that's really the hack to multifamily is finding the right partnerships. It's not knowing all the things about everything multifamily. Like most people don't, and that's something that comes over time. But the hack is finding people you can partner with and you can leverage their time, experience, skill, and effort to making sure that you can also do a deal too. So I had a friend call me up, and we're still good friends to this day. He invests with me, I invest with him, and now his portfolio is probably around like 2.5 billion. So he's a sizable portfolio, but he was just starting out back then. And he called me and said, "Hey, Vina, let's partner up on a deal together." And I said, Okay, okay, is this possible? Can I do this?" And we closed it. It was a $15.9 million deal in Dallas. What's hilarious about this is you can't even get 200 units, even in class like C or D, for that pricing now. And so this was many years ago. We bought that deal, ended up giving back investors back 40% of their principal through, I can't remember if we did a refi. I think we added a supplemental in month 15, and we pulled out 40% of investor equity, gave it back to them, and then exited 3 years and 3 months from the time we bought the asset, and we ended up selling it for like around 24 million, and that really solidified our investors relationships with us, and then investors started re-upping with us and investing in more deals with us, and that's how we were able to
Did you
grow.
buy another single family home
That's
after
so
that?
cool.
So I try not to buy single family homes, generally speaking, but I like accidentally buy some here and there. So I bought another house in my neighborhood, and that asset I've sold most of my single families. I have a few still. I think I have like 6 or 7. But I bought another one in my neighborhood across the street from the other house I own that my parents live in. My in-laws live in that one. So they live across the street from each other, 10 minutes away from me. And then last year in like October, I ended up buying a single family home. It's in Orlando somewhere. It's operating as an Airbnb. I've been to Orlando like 6 times since I bought it, and I have never once visited it. So I don't know what it looks like. I don't know like anything really about it, but it cash flows, it does well. But I bought it. It was my first and only sub 2 deal I'd ever bought. And so we were able to buy like a $450,000 house for 35K down, and we make like several thousand a month from it.
Got it. So curious on that deal, because for a lot of creative deals now, the problem is they don't cash flow or even break even as a long-term rental. So is the short term the only play for your deal, or it also cash flow well as a long-term rental?
So it does cash flow as a long-term rental, but way less, like maybe a few $100s. And realistically, right, and this is an equation a lot of people miss, but if you're not managing it yourself, you have to pay someone to manage it. So it would basically break even at that point. The way I look at it strategically, right, from an investor standpoint, is even if it's breaking even, I'm still building equity from someone else's rent payments. So I don't mind breaking even. I don't even mind it being a little bit in the negative for my portfolio. Now, I'm not suggesting that you do this in your portfolio or with any of your investors or anything like that. But for me, because the tax benefit is so great of having real estate, even if I'm putting in a few $100 a month, it's still worth it for me to have those types of assets in my portfolio. I just prefer to do it at scale now, which is why I like
Hmm.
multifamily.
Yeah, for sure. And I definitely agree with you to make that jump. The partnership, the team is really important. And
Yes.
we'll have more detailed, conversation about that later on. But I want to just quickly summarize your reason for why multifamily. Sounds like two aspects. The first one is it's more scalable. The second
Yeah.
one is we think is resilient to the economy, no matter what economic situation it is. People always need a place to live in. Is there any other reason why you chose multifamily?
I think once you kind of see what multifamily has to offer, it's really hard to look at other asset classes. So, multifamily has a highest Sharp ratio, which is a risk adjusted return. So, for the least amount of risk, you get the maximum amount of potential return. And to me, that's really important, especially because most of our investors are a little bit more on the conservative side. We're conservative investors. And, I say all this like it's recession resistant, and multifamily is facing probably one of the hardest moments it has in over a decade. Um, and I say that, but I also would say that when you look at like comparative asset classes, right? Office space is really struggling right now. Retail is starting to struggle. Brick and mortar just doesn't do as well as it used to. Industrial is doing actually okay, but not phenomenal. Assisted living is starting to do well again, but COVID really impacted a lot of these industries.
Yeah. I
Yeah,
mean, it's
for
getting
sure.
now where like, companies could save, thousands of dollars by not having an office space. Everybody could just work from home. You have Amazon pretty much kicking out all of the retail stores because people just want to click buttons. So, but the one thing that won't ever get virtual is where you're living. You're not going to be living in like a simulated world, right? So you're going to always need an apartment or a place to stay. So, yeah, that's, yeah.
Exactly.
So, Vina, you also mentioned, with the rates being cut right now, which is likely to keep continuing, which is wonderful news for all of us as an investor. And
Yes.
Hallelujah.
by the way, And also, with the election coming up and all that, what's your view? What's your take on the market, like short term and long term for multifamily and across the real estate in general?
Yeah, so I think in the short term, we're still going to have a lot of pain and pressure on multifamily, but just real estate in general. I think we're going to see a lot of that pain remain. And I've been saying this for years. I'm sure there's footage of me saying this from 4 or 5 years ago, but I think that the next housing crisis is not actually going to be what happened in 2008. It's going to be affordability. And I think we're kind of seeing that now, right? Affordable housing is, I think, a good opportunity coming up in the coming years. I also think that 2025 is going to present a lot of opportunity for newer investors, or even seasoned investors, to come in and get some great deals that maybe wouldn't have existed from distressed sellers. I'm already seeing a lot of distressed sales, distress in portfolios. I'm passively invested into many deals, and most of them are capital calling right now. Um, we have one deal which we've had to capital call on, and gosh, it was such a painful decision to make. It took us months to really pull the trigger because we were trying to hold off for as long as possible. And
Mm-hmm.
it was interesting because our deal was one of the last deals. It was the last deal in my portfolio to capital call. But it was one of the last deals in most of our investors' portfolios to capital call. And I'm grateful for that because I think a big part of that is we underwrote it pretty conservatively. We were able to survive through more turbulence, but it made it really challenging because when we did end up having a capital, and this is only on one of our deals, it's like our redheaded stepchild deal, right? But when we did have to end up capital calling that deal, a lot of our investors were super supportive, and we're very appreciative of how we handled the capital call process, which I'm grateful for the experience and that we were able to handle it so smoothly. But it was really tough. And it was even harder because a lot of investors didn't have liquidity because they just met capital calls a year ago from other sponsors that they're invested in. So it's kind of like two sides of the same coin. It was hard either way. I was just talking to my partner about this yesterday, and I was like, I don't know if we had done it earlier that it would have been better because we would have been doing it before we truly absolutely needed the capital call.
Mm. Yes. So one, I won't get too technical, but I'm really curious to learn. Let's say if some investor is not able to put money in when you do the capital call, and some others are able to. So are those people who are not able to, their share will be diluted, or how does it work?
Yeah, so usually what will happen is that share gets diluted for whoever didn't participate. And then above and beyond that, at least the way we structure our capital call is those that do participate get prioritized. So anybody who doesn't participate gets deprioritized in the capital stack. And so I think it's really important to understand those structures, and every sponsor will do it differently. It's not like there's a hard and fast way to do it. There's generally accepted practices, but that doesn't mean that that's how every sponsor will do it. We've been really creative with how we did ours, um, just to make sure that we are protecting the interests of our investors and also accurately rewarding the investors that do participate in a capital call.
Okay. And John, I want to ask a couple of more questions on the market, and you can segue into the
Yeah,
team and the
that's what I
partnership,
was
all
thinking.
that. Okay, cool. So like, there will be more pain coming to the market, more blood on the street, but also we'll have more opportunities,
Yeah.
especially in the affordable housing field. So like
Yes.
three part of the question actually. The first part is, where did those pain coming from? Like, was that because people overpaying before because the rate was too high before, or where does that pain come from? And the second part is, how can people take advantage of the upcoming opportunity? And the third one is affordable housing. Like, is that Section 8, or what kind of affordable housing are you referring to? We can talk about it one by one.
Okay. Yeah. So your first question was, why are we in this position?
Yeah.
It's a multitude of things, right? First and foremost, when everything is good, everybody thinks the party's never going to stop. The music's never going to stop. The same thing happened in 2008, right? With a slightly different set of facts. But what I think happened, and a lot of people will point to the Apple's Way portfolio in Houston. I'm not part of that deal, so I don't have like firsthand knowledge. I just have what I've also like read on the internet. But they bought a deal with a 3% interest rate at the time, and they did not buy a rate cap. And when your rate goes from 3% to 8% in 12 months, it is very tough, almost impossible to maintain and sustain that level of debt service. So I think that's number one. Now, I will also say that specific portfolio, there have since been allegations of commingling of funds and whatever. So there's probably a lot of other factors that went into it. But I do think we're seeing a lot of operators fold that did not or do not have a rate cap on their deal. That's the first thing. The second thing is seeing inflation at its peak in the almost double digits. We didn't quite get to double digits, but almost double digits, made residents look at housing differently. And this kind of goes to that affordability conversation. But the third thing that I think happened and that we're seeing that has caused a lot of distress in the space is national rents have softened. So it doesn't matter if you're in a great market. In a lot of markets, rents have softened regardless. So I'll tell you, we're invested in Atlanta, and 2, 3 years ago, we were seeing like $600 rent premiums on units that weren't even renovated because the demand was just so high. But now we're seeing like $150, $200 on renovated units. So the demand metrics have just completely shifted. But with inflation being as high as it is, residents are making the decision to rent more. So there's still demand, but it's not as high of demand. And there's an affordability aspect to it as well. So a lot of small moving pieces and very, very sub-market dependent as well. Like right now, if you're investing in Dallas, for example, Dallas is the hottest market in the country, and it has been, and there are no signs of it slowing down. It's continuing to grow. So Dallas is a phenomenal market to be invested in right now. But if you're invested in a tertiary market where you're seeing more economic slowdown or less growth, then that could, indicate signs of issues, especially if you have rate caps that are expiring and you don't have the ability to renew or rebuy down that rate cap. But decreasing interest rates are certainly going to help with that.
Got it. So pretty much it's for inflation, instead of helping the rent to go up, it caused the affordability issue together with more inventory coming to the market, leading to the softening of the rent. Got it. Okay. In terms of like capturing the upcoming opportunity, if you can talk about it from both, active investor GP and also passive investor LP perspective, like how should they be looking out for them? How should they make their decision? Like how should they do their due diligence, etc.
Yeah, so we've raised over $400 million across our portfolio. Over the $1 billion of transactions, we raised about 400 million. With that being said, the passive investor sentiment is very different today than it was even 2, 3 years ago. Investors are scared. And it reminds me of the Warren Buffett quote, right? Be fearful when others are greedy, and be greedy when others are fearful. Others are fearful right now. This is the moment to be greedy, to start getting back into the market. Family offices are coming out off the sideline. Institutional funds are coming off the sideline. There's a lot of dry powder out there that the people who are prepared are going to be able to take advantage of it the best. So LPs, I would encourage you to consider, and I know a lot of them are getting burned in assets. They're maybe losing principal. They're worried about capital calls. They're facing foreclosures. I understand all of that, but I would still say that right now there are great opportunities that don't present that same level of risk because of where the market is today. So if you sit on the sidelines, that's your prerogative, but you are missing out on a lot of opportunity that is here. And the people who can make those decisions today are the ones that are going to reap the rewards of it and the benefit of it in the next 3 to 5 years. Because the one thing we always know, right, is that historically, if you look back at real estate in the market, it has historically always gone up. Even with these little blips and corrections and crashes, it still trends upward over long periods of time. And so this is a marathon, not a sprint. And I would recommend that passive investors think of it that way. This is also a tax efficient vehicle, right? So investing in real estate, especially if you're an equity partner and not a debt partner, has significant tax advantages to most investors, which allow you to make greater returns and have asymmetrical returns on your funds. So that's like the second piece of it. And I think for sponsors and operators, it is getting everything lined up now, making sure you're educating yourself now if you're new to the space, making sure that you're reevaluating how you're looking at deals, what kinds of deals you're buying, looking at maybe even restructuring the way it's always been done, right? Like I think that's the most dangerous sentence in the English language is when someone says, but that's how it's always been done.
Mm.
I don't think that anything should be how it's always been done. I think that there's room for new growth and innovation. We're seeing AI come into the picture a whole lot more. And I think that that's really important. So I think that there's a lot of different things we have to look forward to in the next 12 to 24 months that we can take advantage of.
So basically, sell all your Bitcoin and just start buying real estate, right?
Now, I didn't say exactly that, but real estate is definitely a less risky investment than Bitcoin for sure.
For
Oh yeah.
sure. So for GP who are, looking for deals to purchase, is there a certain asset class you mentioned core plus is your focus right now? Like maybe A, B, or C, like is there a certain asset class you should go harder after?
This is a hard question to answer because the answer is yes. You should do anything or whatever asset class feels like it aligns mostly with you.
Mm-hmm.
Because what I find is a lot of people get stuck in the analysis paralysis phase of going, should I do single family? Can I do multifamily? Should I do multifamily? And then you hem and haw and you just go and you research and learn and learn and learn and learn and learn and learn your way into paralysis. You will never have perfect information and you will never have complete
Hmm.
information. You have to make decisions based on the information that you have at the moment with the best possible outcome with the least amount of risk. So there are investors that invest in class A and make money. There are investors that invest in class B and make money, class C and make money, class D and make money. You can make money doing so many different things in real estate. You just have to pick one and be focused on that and learn as much as you can about whatever asset class you choose to focus on. Like I said, we focus on class B, B plus, really A minus assets now. And we focus on that value add core plus strategy at this moment. But that doesn't mean that we wouldn't look at a deal that was like a core asset that made a lot of sense because of some outlying factor, but we really do try to stick to our buy box and we try to be really relentless with it.
Yeah.
Mm-hmm. Cool.
Now,
Last part of this three part of the question is the affordable housing, right?
Yeah.
Like, is there a particular type you are focusing on?
Yeah, so I don't actually do affordable housing at the moment. It's something that I'm interested in because I see a massive need for it. There's going to be a shortage of 3 million homes, affordable homes in the coming years. And so someone is going to have to solve that problem, right? And one way to do that is to leverage like LIHTC or TIF or Allura or some of these like tax programs. There's like HFC in Texas. There's a lot of tax beneficial programs that you can leverage in order to make these outsized returns on something that's also solving a need. And so I think that this is going to be the future. I don't necessarily mean Section 8, though you can make a lot of money in Section 8. I never like to say no to any asset class just because it's something I don't
mhm.
personally do, because I know a lot of people that have done really well in Section 8. So it really just depends on what your appetite for risk is and what your investment thesis and strategy is as an individual.
Cool.
Makes sense. So with all of these zeros in your portfolio, you definitely, well, unless you could, but I'm assuming you didn't do this by yourself. So do you have like a core team that you use? And if so, like what does that like structure look like for the team?
Yeah, so I mean, I'd love to say I did it all by myself, but it wouldn't be as fun and it definitely would have taken me a lot longer than it did. Because like I said, like partnerships are that's the hack. That is the easy button. That is the shortcut is having a community and having people who are like-minded partner with you. So with that, my team as it stands, so we're programmatic partners with Blue Lake Capital. So Vi Funds and Blue Lake Capital co-invest. We co-GP, but we're programmatic. So we basically always assume that we're doing a deal together with someone else. So that's number one. And my sister is my partner at Vi Fund. So she's my integrator. She's like for all intents and purposes, she handles all of the operations of the company. I'm more the visionary. I'm on the other side of the coin. So we're really good complementary skill set. And Blue Lake is run by Ellie Perlman, who is an amazing, I call her like a sniper. Like she is so strategic. She focuses and then she snipes the goal. And she's very grateful to be partnered with her. So we're the three like main partner level. And then our teams consist of so many different people that touch our deals, right? Both internal and external. We have underwriters, we have asset managers, we have investor relations, we have a business development manager, we have, our admin staff who keep our whole worlds running. And then we also have our securities attorney, right? So we use Nick McGrew from Polymath Legal out of LA. Our tax strategist is another key partner for us. Believe it or not, my mindset coach is someone I would consider a strategic key partner for me, because she helps me manage the real estate here, which is so much harder to manage than any building I've ever managed. And so I use Rosie Noel, who you may or may not know. She's
Clifton
incredible.
Strengths, right?
Yeah, Clifton Strengths, exactly. So she does high level executive coaching and Clifton Strengths, and that's like the big tool she uses. But I've fallen down the rabbit hole of Clifton Strengths, and I'm obsessed with it. Like every day I'm learning something new about it, and I'm obsessed with learning about it because it's helped me unlock so much potential here.
How important would you
Yeah.
say mindset is in general for like any avenue you're going down?
If I could do only one thing and I could have only one person, it would be Rosie. I don't need anybody else, because if I can't get my mindset to where it needs to be, then it doesn't really matter who else is on my team, because I'm never going to be able to do the things that I want to do, and I'm never going to be able to live at my full potential. And I didn't invest into my mindset or personal development until very recently. I'm talking in the last like 2-3 years. And oh my gosh, since I've done that, I've had so much more growth, and I've made so much more money, and I've done so many more things. And it's all because I'm managing the right real estate first and then managing the rest of it.
So basically, if you could go back in time, you'd have invested in the mindset early in the beginning before
Without a
everything
doubt.
else.
Without a doubt, that's the first place I would go. And I would say to anybody who's starting out and is unsure about that investment into themselves, it's hard because a lot of times we feel like we're not worthy of it, or that we can't do it, or we don't deserve it, or something else deserves our priorities. But what I will say is, from investing in my own mindset and my own personal development, I've shown up as a better leader for our company. I've shown up as a better operator for our investors. I show up as a better mother to my children. I show up as a better wife to my husband. I show up as a better daughter, a better sister, a better friend. So there's a lot of intangible benefits that you won't necessarily be able to say, like, oh, I paid $300 for my group coaching call this month and I made $7,000 from that. It's not a straight line calculation like that, but it is something that you absolutely will see an ROI on if you're looking for it, and you can recognize where you're making decisions that you maybe wouldn't have made otherwise. And you're making them because you now have the skill set to do so because of your personal
Yeah, and
development.
your identity completely shifts too. Like if you're
Yep.
somebody that, oh, I'm not organized, you believe that, like you're gonna find reasons why to prove yourself right.
To not be
Right,
successful.
exactly.
Yep.
Like success starts here and now. It doesn't wait for something to
Yep.
happen.
Absolutely.
That's great.
Yeah.
So it almost seems like a critical team member, or one of your most important, and we'll make sure the other people on your team don't see this part. The most important team member has
Yeah.
been Rosie and your mindset coach.
Yeah. I mean, I actually think if you asked my team, they would agree because they
Right.
benefit from it too, right? Like my employees, my partners, they all benefit from me
Mhm.
doing this work. So it's really a win all around, but it allows me to show up in a better way for them too. So, yes, don't let them see that, because I actually can't live without my team. They're amazing. But if I have to pick one thing I invest time and energy and effort into and prioritize above everything else, it
Mindset.
would be Rosie.
So for the blue light, the partner, are they called blue light? Is that
Blue
right?
Lake, yeah, Blue Lake Capital.
Blue light capital. So are they like the actual operator in terms of doing the renovation, value add, managing tenant, and all that? What's the role allocation between your fund and their role?
So we co-GP on everything. So the interesting setup about both of our teams is we theoretically can operate cradle to grave independently of each other.
Mm-hmm.
But we've done like I don't know, maybe like 600 million in transactions, maybe a little bit more. I'm not actually entirely sure. But because we've done so much together, Ellie and I just work really well together. So we choose to be in this partnership. And as far as how we divide and conquer, basically every deal is a little bit different. And we get together right at the beginning. We go, okay, who's going to take on due diligence? Who's going to do this? Who's going to do that? Who's going to handle asset management? Who's going to keep our analyst on payroll? Like, we basically find a way to divide those, and then based upon whatever that division is, we'll allocate the equity of the management entity to either Ellie or myself, Blue Lake or Vive.
Got it. Okay. So you would say you are more like the visionary, and your sister is an integrator, and the other lady, she's the operator, or?
Oh, okay. I see what you're asking. It's not quite structured like that. So, we have a heavy focus on we play a role in the acquisition side of it. It's not our strength. That's definitely Blue Lake's strength. So
Mhm.
they handle more on the acquisition side, but we still divide and conquer. And everything that we do, we're in constant communication. So we constantly have validation from each other. Like, oh yeah, I think we should do this. Right before I got on this call, we were just talking about a deal that we're in right now. We're getting ready to close it in Dallas, and we were talking about what the equity structure looks like, right? But it's not solely hers or solely mine, but I oversee more on the legal, tax, structure, equity side than the Blue Lake team does, but she handles more on the due diligence side or the acquisition side than Vibe does. But there are still roles within all of these that we play. Asset management, it depends on the asset, but generally speaking, her team will lead on asset management, and we will collaborate and take some slices of that off of their plate so that they're not spread too thin. And then and the same is true for the reverse, right? Like, we both raise equity for the deals, but when it comes to like structure or the legal or the tax side or distributions, things like that, our team is the lead on that, but her team has input and will take some of those tasks off of our plate.
Very, very valuable partnership. That seems like. So
Absolutely. It's the best
how
partnership
do
I've
you
had.
like? What was your like deciding factor, or how did you start picking Ellie as like a partner, and what did you look for, as far as a partner, and what should people look for when they are picking partners?
Yeah. Okay. So this is like a marriage, and who you choose to partner with really, really, really
Mm.
matters. And I know this from experience. I have had many bad partners. And the thing that was true about all of those partnerships is, one, they either undervalued me. And when you have someone who feels undervalued in a partnership, it's really hard to get past the resentment that inevitably builds. So that's one. Two, another reason that my partnership with Ellie is so strong is because the one thing that I wish I would have always looked for that I didn't look for is something I found in Ellie, which is an unwavering dedication to our passive investors. One thing I know for sure, no matter what, is that both of us always act in the best interest of our investors. And all three of us, really, right? Like my sister, Ellie, and I, all three of us will always do things and make decisions based on our investors, which I think is the most crucial aspect of this game. Because I have that, what's also really nice is there's a lot of respectful discourse, disagreement, and discussion that happens. So it would neither of us and Priya, like none of us are yes people, right? We're not yes women. We don't just like say, oh, yes, 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 yes. We say, wait a second. Priya, I really appreciate that you're bringing this forward, but I see it a little bit differently. And then I share my perspective, and that might cause Priya to adjust or feel more strong about her position and improve her arguments. So either way, we're always winning. And the one thing I know is that just because there are different paths that lead to Rome, ultimately we have the same destination. So if you're looking to find a partner, have those hard conversations up front. Test the waters. Do not jump into a partnership. That's something I have not done historically, and I got a really good chance and opportunity to do this with Ellie. And we did one deal Then we did another deal and it went well. And then we did another deal and it went well. And that's how we became programmatic partners. It's almost like a handshake, unspoken thing for us at this point. And it also allows us the flexibility to come in and do a deal or not do a deal together. We have the ability to say, oh, I don't think that's going to work for us right now. Not that that's happened, but it definitely is on the table, and there's the ability to do that, which I think is important. But I think that when you're looking for partners, have those hard conversations up front. Do not split everything equally. This is another thing that new investors do that avoids the uncomfortable conversation up front. But the reality is you're not going to be splitting everything 50-50. Probably one partner is going to do more and another partner is going to do less, and that's okay. But you need all partners to feel they're being adequately compensated for the amount of work and what they bring to the table. I had partners in the past that have undervalued me and my contribution, and so it ends up being resentment, or they want to make decisions that I just don't agree with, but I have more expertise and experience and I have different priorities than they do. And so decisions become contentious, and that becomes a very stressful partnership early on. And when everyone's making money and everything's going well, you won't see it. It's when the economy starts to shift or something's not going right or something's happening that you start seeing the bricks crumble, so to speak. And look, I told you earlier about how Ellie and I have one asset that we are capital calling on, and that is the most stressful decision either of us have had to make business wise. But our investors rely on us to make the hard calls, to make the hard decisions. And I will tell you, if Ellie and I were not on the same page every step of the way with the same focus, that would have ended very differently and it would have been a lot tougher. I mean, we've never missed a debt payment on that asset, despite where the asset is and despite how challenging it has been. So that should indicate, right, that a strong partnership can keep an asset afloat and keep a bad asset performing okay. So you care more about the jockey, not the horse. And when you're choosing your partners, choose them wisely, because you are likely going to be in partnerships for years at a time when you're in the multifamily game. It's not a flip where 90 days, you know that this is a bad partner, you're done. It's like 5 years, 7 years to see if this is a good partnership or not.
Yeah, I think it's
For
very,
sure.
very important to like have that dating period before you tie the knot and put it on the
100%.
paper.
And like when you guys come across, because for a partnership or whatever, there will always be discourse, disagreement. But that intelligent conversation to triangulate the thoughts with each other is actually pushing the business forward. That's how we evolve and have the groundbreaking through growth. And I think for me and John, we always have disagreement on things, but as long as we know we are working towards the same goal and setting aside the
Yeah.
ego, because it's not about like we're talking about you did something, it's about how we accomplish this one together, setting aside the ego.
100%.
Yeah, and figuring out, okay, what's the principle for us to solving the disagreement, and then we follow the principle to solve the disagreement, and then for the ultimate goal of becoming better together. That's really the critical part
Absolutely.
for a partnership.
Yeah. Got to
Absolutely.
leave the ego at the door, otherwise nothing's going to get solved.
100%.
So before we get into, because you guys speaking about capital raising, capital calls, and it requires money to start buying these assets. What have been some milestones for your business, and where do you see the future of Vive Funds kind of going?
Yeah, so milestones for the business. I think we had a lot of wins last year. We crossed the $1 billion mark last year, and that same asset was the largest all-woman led transaction in the entire country in the multifamily
Wow.
space. Yeah, and so that felt really important for a bigger mission of diversity and equity. So I think like being able to have those conversations in a more powerful and meaningful way, that I think is a big milestone. I think the future of Vive really is to continue putting out very boring vanilla deals for our investors. I always tell our investors, if you want like excitement, if you want HGTV, we are not the investment company for you. Our private equity funds typically go into deals that are like less exciting than watching paint dry, is what I tell people. Very boring, very bland, very vanilla. And it is important to me because those are the types of investments that our investors are looking for. And so, we're going to stay true to what we do best. I think we are going to start seeing maybe some more opportunities that we maybe wouldn't have had before, like maybe some more seller finance opportunities. We're assuming a lot of debt right now that's sub 3%. So that's amazing. I think we'll see more of those deals and opportunities. And hopefully we'll get an opportunity to pick up some maybe like pre stabilized assets or even like build to rent communities is something that we're very interested in.
Amazing. When's the Vive app coming out?
Vibe app, it's so funny. I have all these ideas for apps, and then I'm like, yeah, I don't really want to build it. I'll just wait for someone else to build it. But yeah, I should. I need an
Yeah,
app.
just invest with the click of a button.
Mhm.
Yeah, I love that. I
Yeah,
need that.
just hire someone, like maybe you
To
pay
build it
some.
out, right?
Yeah,
It's not even that. It's like I don't know what I
Right.
don't know. And so for me to hire someone to build an app, I don't even know how to like interview someone for that. I would have to rely on my tech friends, and it feels like such a daunting and overwhelming task to undertake that I just haven't done it. I haven't
yeah.
prioritized it.
For sure. So I know you are like a powerhouse, a ninja for raising capital. So let's talk about raising capital and like three part of the question. Again, the first part is like there are so many different roles in multifamily, like team sport, right? You have like investor relation, acquisition, underwriting, like asset management, and all that. How can someone find the right role for themselves, like know if they are someone who is having the right profile, personality, skill set for raising capital? Because I know you are extremely extrovert, and
Yeah.
right, so not every single person is like that. So for someone who is more introvert, is that just a no for them to raise capital, or what's your thought on that?
Absolutely not. Raising capital is a skill set that everybody should learn. Whether you're visionary, integrator, introvert, extrovert, none of that matters. What the reason that matters is because your approach is going to be a little bit different, right? This is also why I like the Clifton Strengths so much, because depending on what domain you fall into, you are going to raise capital in a slightly different way. So, for example, I'm orange, so it's the like influencing theme, right? So, I'm going to influence the people around me to make financial decisions or to invest or whatever, right? But somebody who leads with blue, which is relationship building, you want to build deep relationships. So that's somebody that is probably going to do really well with family offices, with large check writers, with individuals who just need a more intimate relationship because people invest with people they know, like, and trust, right? If you are lead with green, right, you're strategic thinking. You are going to lead with data and analysis, right? And facts. And those are going to be the things that are your strength to communicate to investors why they should invest with you or why they should believe in this project. So it doesn't mean you're going to be bad at it if you're not orange like I am. It just means you're going to approach it differently, and that's okay. You can approach it in a way that feels authentic and genuine to you because that's really the way to be successful. If you are somebody who looks at social media, right, and sees like the highlight reel of all of our lives, and then you go out and you try to emulate what I do on my social media, you are going to fail because you're not going to be a good copy of me. You're going to be the best original of you. And so I encourage you, if you're consuming content, be very mindful about what you're consuming. Don't consume content that makes you feel like you have to change your core being or that makes you show up as less than you are able to. Instead, find the people that align with you and follow them for the content. Like, I have a lot of friends on social media who they are like very hard sell. They are very much like sell at all costs. And that's just not my style. That's not
Or
how.
one hurdle can probably be 50 steps.
Yes, exactly. Like, his style is so different than mine.
Yeah,
And
$7 thrill kind of method.
yes. And so that's the thing, right? Is like he's still able to raise capital. He's a great capital raiser. I'm still able to raise capital. I'm a great capital raiser. So there's many different approaches to it. You have to find the one that really works for you. And it is definitely not predetermined or predestined. Anybody can learn how to raise capital and be good at this. It's
Yeah.
a relationship
Hmm.
game.
I love your answer so much. Like it's so helpful. Each individual they should learn how they are designed, like
Yes.
originally first, and then because God designed them, they only need to know like how they were designed initially, and then accept themselves, and then find the right approach for them.
100%.
Yeah, and that's similar to me and John. Because John, I think he's more like influencing type of person. I'm more like a one-on-one high-level relationship, and they're
Mm.
strategic and data-driven. So he bring people in the door, and I close on them with logic, data, and numbers, and then maintain that relationship going forward. So again, partnership and knowing who you are and what's the best approach for you. Don't try to mimic someone making you feel less than, exactly like what you said.
Yeah, and
Absolutely.
also don't feel like
Yeah.
you need to be something like if I was like, no, I want to close the high level relationships. Like I don't want to, like I want to have those conversations. Like again, ego, if that comes in, that's could really cripple. Like not one thing is better than the other. Like whatever you're good at, if you just lean into that, like you'll be successful.
Yeah, absolutely. Totally agree.
Yeah, so that actually segue into the second part question, which is the investor avatar. You mentioned, you maybe look for people who are more receptive to your method, and others are looking for family office or people who are more suspicious, they want the data, etc. Like, how do someone figure out their investor avatar and go after
And
them?
remember, Vina, there's a
Yes,
part C of this question too. Every Helena question
I
has three
know.
parts.
I love it though. I love this. And I feel like you guys are so well organized as you guys are asking me these questions. It allows me to collect my thoughts in a way that I think is probably much more serving of your audience than just like these random questions that just happen. So thank you for being so prepared. Um, so investor avatar, this is what is your ideal client? Like what is the ideal investor for you? Who are they? What does it look like? How do you talk to them? How do you basically like how do you connect with them at a level that feels comfortable and authentic for both you and for them, right? So I run a challenge like every so often called the Investor Avatar Challenge. And I have like a whole workbook and a whole like system that I work through, and it changes all the time, right? Like my investor avatar is not the same today as it was a year ago, 5 years ago, 10 years ago, right? It changes over time. So you have to keep revisiting it and keep updating it. But basically, what you're trying to do is you're trying to narrow down the messaging of what you're saying to whoever your ideal avatar is, right? So let's say, Helena, you said, I'm very analytical. I like to close with facts and logic. Do you lead with green? Is that your Clifton strength domain? Do you know?
I think so. I don't remember exactly, but I think so.
Okay.
Yeah.
Yeah, that wouldn't surprise me if you were green because that's something that someone who leads with green thinks about, right? Whereas if John leads with orange and I lead with orange, right, we're not thinking about that side of it necessarily. We're thinking about how can I reach as many people as possible and build these fast relationships with them, right? And then using those relationships to leverage that to whatever else we're trying to achieve or accomplish. And so when someone leads with green, for example, your investor avatar probably could be someone who is an engineer, right? Because generally engineers really appreciate data, statistics, logic. So now when you know you're speaking to like engineers or tech people, right? Or maybe you're speaking to um, finance people, finance professionals, or accountants, right? Or lawyers. Like these are all the people that might be your avatar. You narrow it down and you say, okay, I I'm primarily speaking to 35 to 45-year-old women in tech. Right now, your messaging is going to be different, right? You might be talking more about pain points that they have that males in their space don't have, or that someone who is an entrepreneur doesn't have, or someone that's a student doesn't have, right? So you have to know and understand who your ideal customer or client or an investor is so that you can message them. Because when you speak to everybody, you speak to nobody. So really understanding and nailing that down is going to help you craft your message in a better way that's going to be more powerful to be able to raise more capital.
For sure. Okay, cool. Last part of the capital raising, and then we can dive into the ending three questions we have for all speakers. So the last part is in this market, what are some common challenges you see people run into as a capital raiser? And I'll speak from my personal experience because most of my investors, they invest for the tax benefit, right? So
Mm-hmm.
last year I raised capital, they have 200% depreciation. Like every
Yeah.
$1 they can write off two. They share is typically between 30 to 40%. So they all take a pause on investing. So what are some common challenges you see people are running into, and how can they solve those challenges?
I think one of the most dangerous things I'm seeing right now is there are a lot of people who teach capital raising. There are a significant number of SEC rules and regulations that we have to follow as people who raise capital. The number of like gurus, mentors, experts that I see who actually are credible in other areas starting to teach how to raise capital, they're doing it wrong and they're teaching you wrong. So you have to make sure that no matter what you do, if you are going to raise capital, if you are even thinking about raising capital, the first thing you should be doing is reaching out to your securities attorney. Like I said, we use Nick McGrew from Polymath Legal. He's phenomenal. Highly recommend working with him. I've been working with him for 15 years. So he's great. That is the first person you need to reach out to, because the SEC has certain limitations on what exemptions you can rely on if you start talking about raising capital publicly before you're ready to. So that's number one. Number two, we're seeing a lot of investors that are high net worth or have really great jobs, especially professionals, right? Like doctors, lawyers, engineers, the C-suite, who historically were making more investments. They're getting scared now. So they're pulling back their money. They're going into scarcity mindset. So I would say if you fall into that category, really reconsider and reevaluate that this is actually a better time to be getting in the market than when we were at the top of the market, which most investors did happily, right? And the problem with market cycles is you never know when you're at the top and you never know when you're at the bottom. It could go up a little more, it could come down right away. We just don't know. And so you have to make educated, rational risk decisions. And humans are notoriously bad at assessing risk. They just are. A human will go further out of their way to avoid a dollar loss than they will to get the same dollar in gain. And when you can work on your mindset, right, and develop and shift that, it will help you make better investment decisions. But I would say if you're raising capital, make sure you know what you're doing, follow securities rules. They are there for a reason. If you think that you are going to like have some creative revolutionary way to raise capital while skirting SEC rules, you aren't. They're not dumb. They can see through this, right? Like if you are offering a security, you might even do it without realizing you're offering a security. And that's why you want to make sure you have a securities attorney, not just any attorney, specifically a securities attorney advising you and giving you the green
Yeah,
light.
you don't want to be ruined before you even start.
Exactly.
Yeah.
Yeah.
It seems like just like there's an app for everything, there's a guru for everything as well. Be very careful who you listen to.
That part. Yeah, it's so scary to me when I see people in these positions of power because, as somebody with my own platform, I have a heavy responsibility to the people that are in that platform because I know they're trusting me and I don't want to take advantage of that trust. I don't want to guide them in the wrong way. So you'll see me a lot of times when someone will ask me a question, I'll be like, listen, I'm uncomfortable giving you the answer to this because it's so nuanced. And, it's like when I talk about referral fees, for example, people are like, oh, can we do referral fees? And I'm like, you can pay a referral fee. There is a way to do this that is compliant. I'm like, but I hate talking about it because I know that there's going to be someone who listens to the one sentence where I said you can
Yep.
do this without listening to all of the nuance and caveats around how you can do it. And then they're just going to run with it and they're going to be like, oh, but Vina said. And I'm like, no. So I feel like we have a responsibility to make sure, like even you guys, right? Like you have a podcast, you have a responsibility to make sure that you're not giving the people who are trusting you and listening to you bad information, especially when it's something as serious as the implications of raising capital.
Yep. Yeah. So everybody listening,
1000%.
make sure you listen to the whole thing. And
Yes,
my social media manager, make sure you don't cut it too short. All right. Not to get in
for real.
trouble. So, Vina, this has been honestly very informative and a great conversation. Unfortunately, it has to end because we all have to move on, right? But we always ask our guests 3 questions. So we wanted to start with
Okay.
you is what are you doing consistently every day just to maintain like that mindset, that success and happiness mindset that you have going?
2 things. One is I actually try to coach with Rosie every day.
Wow.
She doesn't answer my calls all the time. She's like, I have other clients.
Yeah,
I'm like, I don't
every-
care. Book me for 5 days a week. I want to start off my day coaching with you. Most mornings I start off coaching with her. The second thing that I do every day, I'm low consistency on my Clifton strengths. I'm not someone who's a consistent person, But what I do, because it's so important to me, is every day I'm having mindset conversations with my
Mm.
children.
Mhm.
So I am helping them develop their mindset from a young age. Like just yesterday, my daughter Via was like, yeah, mommy, I tried that thing and I wasn't good at it and I failed at it, which is one of my goals for the day. And I'm like, oh my gosh, good job. I'm so proud of you. She's like, yeah, but then mommy, you know what happened? I ended up getting it right because I kept trying and I kept practicing and I got it right. And I'm like, amazing, because that's the growth mindset, right? It's not about the outcome, it's about the process to get there. And I want them to have that grit and that resilience. So those are the two things I do every day that help me with my own
That's
mindset.
amazing.
They will definitely appreciate you a lot when they grow up, like
I
all the
hope so.
impact you have on them.
I
Like I
hope
never
so.
got any mindset coach when I was a kid because that was not a priority or even a main topic in especially my background Asian families. So I kind of had
Yes.
reading books, etc., and learn more about mindset. They just think you stop whining, stop crying about it, just go do
Yeah.
it. But it's
Yeah,
so
Asian
important
cultures do not prioritize this.
for sure. Yeah. The second question is like, what do you do consistently to like replenish your knowledge to stay on the like edge of the industry to learn more about different skills, etc.
Yeah, so again, low consistency over here. So there's nothing I set out and I'm like, I'm going to read for 15 minutes every day on these like that will never work for me. I've tried, it doesn't work for me. For me, I tend to consume knowledge in a social setting. So I interact with a lot of people. Like I'm constantly like texting friends and family, like, hey, what's going on in your world? So I can get a better understanding and I can basically crowdsource information.
Mhm.
But really, it's spending time consuming content in various platforms. TikTok is my favorite place to consume content. So I do consume a lot of content on TikTok. I follow a lot of like finance creators. I follow a lot of real estate and investment creators. I follow a lot of women in business, women entrepreneurship creators, so that I can be consuming that knowledge when I am scrolling. It's intentional scrolling, it's intentional consumption. But yeah, I would say like just being in the industry that I am and being as active as I am, I just get a lot of data brought to me. And so, I'll randomly click on an article and read an article that pops up on my For You page. So, and I do interact with articles I like because then that means the algorithm shows me more of that kind of content
Got it.
too.
So you mean you don't have Mudang the hippopotamus hopping on your timeline?
I don't.
It's pretty adorable.
So
I
that's
love
like
it.
the three level of the luck. The first one is, unprepared luck, which is you just run into luck unintentionally. The second one is you are so prepared, it's like prepared luck. You create your own luck. The third one is actually at your level, which is you take advantage of other people's luck. They learn about things,
Mm.
share with you. That's the highest level.
I'd never heard that before. See, like to me, this is part of me learning more mindset things. So I'm going to steal that from you
That's
now.
it. Now, Helena, you got to put it on
You got
TikTok.
Yes, for sure.
Put that on TikTok.
cool.
That should be like a whole reel because I've never heard that before. And I've heard a lot of these like normal sayings like that we all say, right? But that's one I haven't heard and I love that.
Learn something
Cool.
new every day.
Yeah.
And then the last question is for somebody that's scaled their business, right, and continues to scale, advice would you give other entrepreneurs that are trying to scale or in like that kind of like hurdle of scaling?
Yeah, the messy
Yep.
middle. Yeah, I would say, oh gosh, I have so many things I wish I would have done differently or known when I had started. I think the one that resonates most with me today, my dad had shoulder surgery this morning and our 16 and a half-year-old dog is kind of like coming to the end of the road, which is hard. Honestly, when you're so focused on scaling a business, it's sometimes hard to remember why you're doing it. And I think that I've made sacrifices many times that I wouldn't make today because I was so scared of the FOMO. I was so scared if I don't work that extra hour that I'm not going to have this opportunity again, right? And there's nothing that is more important than the people and the family around you. And so it's okay to slow down a bit if you need to. It's okay to pull back to take care of your mental health, your physical health, your well being. I don't think that we prioritize those enough. And I think there's like a lot of this like toxic masculinity that is happening, and especially in our real estate circles where, they're like, oh, I wake up at 3 a.m. and do an ice bath for 100 hours. And then I run at the gym for 6 hours. And then I eat only protein and fruit and vegetable. And I'm like, I literally
And then the
do
sun rises,
none of
and
those.
then everybody else wakes up.
Right. Like, but that's how, and they're like, the reason you're not successful is because you're not doing these things. And I just don't agree with that.
I
Same.
agree.
Fundamentally, I don't agree with that. And I think it is important to remember your why. So, like, a lot of us will say our why is for our family, right? No one ever is on their deathbed wishing they had spent more time at the office. They wish that they had spent more time with family and friends and loved ones because life
Yep.
is short.
Mhm.
And life can only be long if you know how to live it.
Yeah,
So,
that's one of the things. Like, I agree 100% on that, and that's something that I kind of started realizing this year. Like, especially with like my grandma getting like older. So like I've always wanted to spend weekends, as many weekends as I can with her, and I always started prioritizing family now, and I'm like, you know what, it could wait till the morning. Like, I'll do it in the morning. Let me call my mom
yeah.
every day and do that. And another thing too, like I tell people, like, don't find motivation. You got to find inspiration. Like, motivation will make you just move in the moment, but inspiration is going to keep you going in the
Yes.
long run.
I love that. Okay, that's another new one for me. I'm learning so much.
Cool. Well, it's been such a wonderful conversation, Vina. It's like one of my favorite episodes. We learned so much. And, we're super excited to see your journey unfolding in the near future. You have great ambition. You have great team people around you. So, yeah, I'm really
Thank
looking forward to
And you got
seeing
a great
that.
mindset.
thank you for having me. Thank you.
Yeah.
I work
That's
on it.
right.
That's why it's good.
So how can people get in touch with you?
So if you want to connect with me on social media, I actually respond to my own Instagram messages. So
You know,
Vina
I
Jetti
noticed
on all social. Yeah, you know that we DM each other. So I'm Vina Jetti on Instagram, VeeNaJetti. I'm on all the social media platforms, but Instagram's the one where I'm the most active. If you want to learn more about investing in multifamily as an active investor, we have the Mastering Multifamily with Vina Jetti free Facebook group. And if you're interested in passively investing with us, we are open to accredited investors, and you can go to Vive Funds, VIVEFUNDS.com.
Yeah, and for like the challenges like the investor avatar free challenge, those kind of things, how can people keep posted on that?
Yeah. So if you join the free Facebook community, usually we'll post it in there and we'll send out an email blast there so that everyone can participate in it. I'm actually going to get ready to run another one probably, if not next month, definitely in November, just because everyone kind of slows down and has a little more time to put more
Mhm.
thought and effort and intention into it. So I do run those relatively frequently, but the goal is to increase the level of frequency.
For
Love
sure.
it.
Okay, all right, guys, definitely join the Facebook group and follow up on the news there and follow Vina on Instagram. Again, Vina, thank you so much. We have such a blast here. Appreciate
Thank you.
it.
Thank you for having me.
Appreciate you for
All right,
coming.
guys, have a nice day. We'll talk
Take care,
soon.
everyone.
Bye.